Hello, I'm Mike Molina, and I get a lot of questions still about the Federal Reserve, what it means that they're raising interest rates, how it affects mortgage rates and inflation, and why now is a good time to buy. So I'm going to go over just a few things with you real quick, and if you have any questions, please feel free to contact me anytime. So first up, what is inflation? I think everybody probably knows, but just in case, inflation is simply a rise in prices, which can be translated as a decline in purchasing power over time. Obviously, if things cost more and you don't have more money to buy things with, then it decreases your ability to buy things. And when the pace of price increases outpaces income, then that becomes a real problem, especially in regards to inflation. And so what can cause inflation are several factors: the cost of producing goods, the prices of goods, demand for goods, it's skilled labor, but just labor in general, availability of people to do whatever job might be out there that needs doing, new technology, and monetary supply. So in regards to the situation that we're in right now, what's caused the current inflation is an increase in monetary supply, which was done during the pandemic when the government was just giving out checks to everybody. Supply chain disruption, which we all know about, that created demand inflation because people needed products, there weren't enough products. Basic law of supply and demand: if there's not enough product, there's only a little bit of product, and everybody wants it, you're going to increase the price on it because it's a valuable commodity. Government-sponsored unemployment. The government was literally paying people to stay home, which created a labor shortage, which means people that needed employees had to pay exorbitant rates to get people to come to work for them, and so the cost of their goods in turn was increased. And poor government monetary policy. That's more of a political statement. I'm not going to get into that, but let's just leave it at that. So, what is the Fed funds rate? Well, the Fed funds rate is the rate that you hear is being raised. So when you hear the Federal Reserve is raising the rate today, as they just did on today, May 4th, 2023, they raised it 0.25%. That is a rate set by the Federal Reserve that banks lend money to each other overnight at that rate. And that rate affects other lending things, but it is not the mortgage rate. It is something entirely different. Now, it can affect mortgage rates indirectly, but there is no direct correlation between the Fed raising the Fed funds rate and mortgage rates. And in fact, I'm going to show you in a minute how raising the Fed funds rate actually causes mortgage rates to come down. So let's take a look at that. So when the Federal Reserve raises the Fed funds rate, which is the short-term rate banks borrow and lend money overnight to each other to, then mortgage rates are not directly affected. And student loans are not directly affected. Credit card loans, those are affected, but because the balances are relatively small compared to a mortgage, it may not be as impactful. Okay, home equity lines of credit definitely directly affected, as the home equity lines of credit are based off of the prime rate, and the prime rate is set by the Fed funds rate, with a conglomerate of banks agreeing on a certain rate, which is usually 3% over the Fed's rate. So as the Federal Reserve raises the Fed funds rate, the prime rate goes up, and therefore your home equity lines of credit will go up. And savings rate. So the only upside about the Federal Reserve raising the Fed funds rate is that typically you're earning more interest on your savings deposits. But that's usually not all that great of a trade-off, and people don't see that, don't really feel it in their pocket, so it's not really talked about all that much. So, what is the Fed funds rate, the prime rate, and how does it affect everything? So, as of today, May 4th, 2023, the Fed funds rate is 5.25%. Now, to that, this conglomerate of banks have agreed that the prime rate will equal that rate plus 3%. So, if you've ever heard of the prime rate, this is what we're talking about. So, the Fed funds rate plus 3% equals 8.25%. This is the prime rate as of today, as published in the Wall Street Journal. The Wall Street Journal sort of is the authority on what the prime rate is. All the banks agree, but they publish it, and that's where people go to find out what the prime rate is. So let's take a look at inflation, okay? So this is a graph of inflation going all the way back to 1970. And these gray bars that you see right here where I have these red arrows, those are recessions. So all the way back from before 1970, all the way now down to the beginning of 2023. Now, if we lay on top of that the Fed funds rate, what you will notice is that there's a similar pattern. And what you'll see is that as inflation goes up, then the Fed funds rate goes up. Because what the Federal Reserve is doing, remember, inflation is cost of goods getting too expensive. The economy is overheating. So what is the Federal Reserve doing? They're raising the Fed funds rate, which is going to raise your credit card rates, it's going to raise your home equity rates, it's going to raise your car loan rates, it's going to raise everything. It's to make borrowing money more expensive, which slows spending and the purchasing of goods. This in turn decreases demand, which helps to curb more price increases on goods and even helps bring the cost of goods back down some. And so as you will look at this graph, you'll see that as inflation goes up, the Federal Reserve raises the Fed funds rate to slow spending, to push inflation down, which it eventually does, and then the Federal Reserve in turn lowers it. And this is a repeating process that you can see has gone on for decades, and it always works. This is the primary function of the Federal Reserve, is to make sure that inflation stays under control. So what does that mean for mortgage rates? Well, here is the 30-year fixed mortgage rate going back several decades. And what you will see is that this red line here is the 30-year mortgage rate, and the green line is inflation. And if you notice, they're very, very similar in their movement patterns. In other words, mortgage rates always follow inflation. So when the Federal Reserve raises the Fed funds rate, mortgage rates actually can go down because the markets see that the Federal Reserve is handling inflation and they take that to be positive, and the people that have the mortgage money, they go, oh, inflation is coming down, and so cost of mortgage borrowing goes down accordingly. So while there's not a direct correlation between what the Federal Reserve does in terms of raising of the Fed funds rate and mortgage rates, there is an indirect correlation because of the consequences of them raising the rate. So as they raise the Fed funds rate, pushing inflation down, we see interest rates coming down. And that's what we've seen recently. So we hit a high of interest rates in November of last year, 2022. And inflation started to dip every month, year over year, starting November, year over year, December, year over year, January, February, March, April. And as every month, year over year, we've seen a decrease in inflation because the Federal Reserve has been hiking rates. We've seen a corresponding decrease in the 30-year mortgage interest rate. So that's why when people hear on the news, oh, the Federal Reserve raising rates, and they panic and they think that mortgage rates are going up, that's not true. They're actually going to come down. It doesn't always correspond to just like that, especially in the beginning when they first start raising the rates. But as the cure for inflation, which is the raising of the rate, kicks in, then mortgage rates respond accordingly as they follow inflation on their downward trend. So if I blow this up just a little bit, this is just the same graph, just a more magnified snapshot here for our more recent times. Here we have the beginning of 2022. This is about when you see, so this green line here, again, is inflation, okay? And the blue line way down here at the bottom, which is, at 0, was flat, right? Then in 2022, we start to see inflation inch up. So the Federal Reserve is like, oh, okay, so we better raise the Fed funds rate. And then inflation continued to go up. And so the Fed got more aggressive. And then inflation continued to go up. So they got even more aggressive. Now what are we seeing? Now we started to see a turn down. And the Federal Reserve is still raising the Fed funds rate. They're probably done for the year now. They're probably done for quite a while. The next thing they're going to do is start to cut it. And as you see inflation turning the corner and starting to head back down, look at that, mortgage rates also turning the corner and heading back down. So how does it work? So the Fed funds rate is used to control inflation. It is raised to cool down an overheated economy, and it is raised to stimulate a too cool economy. That's exactly what they did when the pandemic hit. It's like, bam, we got to drop it down to 0 so that we can keep the economy going and keep it moving. Long-term mortgage rates follow indirectly as they follow inflation. All right, so what is the economic cycle? First of all, an event triggers the onset of rapid inflation, growth things becoming too expensive. The Federal Reserve raises the Fed funds rate to cool down the economy, and then a recession is generally triggered. The economy goes cold. The Fed starts cutting the Fed funds rate to stimulate the economy, and rinse and repeat, and we do it all over again. And that's how it's always been, and that's what's happening right now. So why is now a good time to buy? Well, One thing that most people don't think about or talk about is the immense tax benefits of owning a home. You can write off thousands and thousands of dollars of your IRS tax obligations every year. The first year alone, depending on the price of your home, you could write off $10,000 to $20,000. That's real money in your pocket just because you own a home. You can't write off your rent, right? So people always ask me, well, what's the current rate? Well, I can tell you, regardless of what the interest rate currently is for owning a home, the interest rate on renting is 100%, right? Because there's nothing in it for you there. It's all money going to your landlord. You get no benefit from that. Now, we know that there's a national housing shortage. That's been that way for quite some time. Household formations are coming in faster than we can build and create new homes to accommodate them, and so that is going to create demand. So here we go again. When demand, outpaces supply, prices go up, and that's exactly what we're seeing. That's why homes are starting to go up again. So rents are still increasing nationally quite a bit, and so renting is generally as or more expensive than owning a home in terms of costs on a monthly basis. We're starting to see the competitive market signs that we saw in 2020 and 2021 come again. So that was multiple offers on every house, massive offerings over the list price on every house, and just this wild competitiveness that drove prices up so astronomically and so crazy. So if you buy now, you're going to have appreciation working for you rather than against you. So remember, you only get to buy the house once. Once you bought the house, you've bought the house. You can't buy the house again at a lower price, right? But your interest rate is different. You can buy the house now at a low price at a rate that's a little bit higher, and then refinance in 6 months to 12 months later and get a lower rate. As we like to say in the mortgage industry, marry the house and date the rate. So, food for thought. If you have any questions, please feel free to give me a call. I hope you have a wonderful day and look forward to talking with you soon. Take care.